retaining ownership, right? And so the difference between that and an earnout is that like now you're growing because you still own part of the business. Usually an earnout is done when someone's buying 100% of the company and you have to earn more of the money that they're going to give you by hitting numbers. In some cases, it's definitely worth taking that deal again if you believe that you can achieve those goals. But in other cases, it might be best to just try to tighten that up and take the money and go do something else.
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have Joe Zanca on the mic. He's a managing partner at Dealgen Partners, where he helps private equity funds source off-market deals before anyone else. Before Dealgen, Joe built and exited on-demand storage, launched a top-rated business podcast, and most recently joined Bullpen Technology Partners. He's got founder grit, a banker's Rolodex, and sixth sense for where the next deal might come from. Thanks for coming on the show, Joe.
Thanks, Brian. Thanks for having me, man. This is going to be exciting. I'm happy to be here.
Yeah, I know we've been planning this for a while, so it's great to finally get you on the pod. I usually ask the same question to kick it off, which is, what is your origin story?
Yeah, a little on me. I grew up just outside of Boston. Went to college. I've actually lived here my whole life. Went to college at Babson College, which is also just west of Boston in Wellesley, Mass. I've studied entrepreneurship, played baseball, started a business when I graduated with two of my teammates. I'm called On Demand Storage. We grew it for about 7 years, and then they actually, partners bought me out, so I had an exit from that, and just wanted to take it different directions. It was the only thing we had ever done, so I was kind of getting the urge to maybe try something different and expand, and it was a amazing learning experience though, and those guys are still doing really well with it. So overall great exit for everybody. And then I actually started Dealgen Partners shortly after that. So my business partner, Brian Scanlon, who I own Dealgen with, he was actually my assistant baseball coach at Babson. So he was an undergrad and then was there getting his MBA and was doing the assistant coaching, recruited me to come there and play. So everybody I've ever done business with is from the same school. So I guess I only know one thing. So Brian, after I sold my company, Brian was, doing some sell side M&A work. He had already had an exit himself too. And when we came together, we recognized kind of a cool opportunity to take what we learned, marketing each other's previous companies, apply those strategies to deal sourcing, right? So it started with one client who hired us to help them find distressed software companies. And that went really well. We actually succeeded. And it's a funny thing in business, when you have early success, you think sometimes you can mistake that for being really good at something instead of just maybe getting lucky a couple times too. So we dove headfirst in, thinking, hey, we know everything about this space already, even though we've only done it for 6 months. And that's when we actually really started to learn, hey, what goes into sourcing, what goes into building good relationships, what is a profile of a potential great buyer for us to work with. But as we were sourcing these distressed software companies, not only were we sending those to our client, but we'd also come and find deals that weren't necessarily distressed, right? They were just good companies that had CEOs or founders that were interested in selling. So our client didn't want anything to do with those because they'd have to overpay. So we would put them in a folder, reach out to other funds and say, hey, we found some opportunities you might be interested in, and then tell them what we do. And we grew our business that way. So kind of just bootstrapped it one by one client. Fast forward to now, we're about 5 years in. And, at any given time, we're doing, 5 to 10 searches on behalf of PE funds, independent sponsors, and private equity backed companies. So company that might already be owned by private equity that's looking to do a roll up. And in some cases, search funds and family offices too. So if someone comes to us, who we think has a interesting strategy and something that we can succeed at, we'll take a listen. And if we can get aligned on, the goal, then it's something that, we'll try. We're pretty agnostic when it comes to what we search for, as long as, again, the buyer has a good thesis as to why we should be searching it.
Wow, that's quite the journey. So I would love to unpack the on-demand storage and what it maybe taught you about buying and selling businesses or helping private equity firms to do that. Like, how do you think all that startup experience and knowledge is helping you today?
Well, I think where it helps most is that today, right, when I've been a founder, right, I grew a business with on-demand storage. We had a little seed capital from family and friends that we used to start it, but we didn't raise like venture capital or anything like that. Again, it was another bootstrapped venture that, I was 24 years old, and me and my business partners were, signing 3 5-year leases on buildings, 8 10 grand a month. So we were like doing stuff like that, and it wasn't reckless. We had money coming in. It was just like really doing business. There's you can get an idea when you're at Babson, you can get an idea when you're in your dorm room. And then when it comes to executing on it, you have to actually go out and do things like that where you're personally guaranteeing, 3-year leases and things like that. And, convincing, we used to do a lot of storage for colleges and institutions and boarding schools. So, winning those contracts, putting in a process in place to submit RFPs and win those contracts is something that, again, like we didn't really have, we weren't taught how to do that. We just had to like learn on our own and do those things. So where I'm going with this is, I've only had one exit myself, right? But where it helps me in understanding the process is when I'm talking to, a founder, a business owner, whether they're, closer to my age or in their 60s, who's looking to exit a business. I've been in their seat before. I've owned a company, I've grown a company, I've had, 50 employees working for me at one time. So that being able to relate to them from that standpoint is really helpful. I think that it's a very noisy market these days. There's a lot of people reaching out to them. There's the buyers, there's intermediaries who are looking to help them sell their business. There's so many people out there trying to buy businesses now. It's just like if you have a decent company, chances are people are able to find that out and they're able to find your information and call you. So for us, when we get on the phone with business owners, one unique characteristic is that pretty much everybody that works at DealGen now has owned another business and sold another business. So we can relate to that person. We can tell personal stories. We're not, nothing against anybody who is, but we're not just, business school kind of Excel jockeys. We've operated. That, when it comes to getting in the trenches and building relationships, matters a lot to those founders that, hey, this guy kind of understands what I'm talking about and isn't just, a person behind a computer only looking at my financials, right? They understand that like I have people that have worked for me here for 10 years. And when I sell this thing, they need to get taken care of. And because I've built a personal relationship with them, like we know what that's like. So I would say that's the biggest factor that, on-demand storage taught me is like how to operate a business, what goes into that, what really goes into that, paying employees, sacrificing your own pay, signing long-term leases and loans. Those are things that founders like, you don't, when you're sitting on the sidelines or looking from afar, like you don't realize how much personal liability a lot of those people are taking on and
Right.
stress. And being able to talk to them about that is helpful.
I have a buddy of mine here in California. I was just grabbing a beer with him the other day, and he was telling me the story in the great financial crisis. And he was a real estate guy. He was 50 million on the hook, like 50 million in the hole, personally liable. Yeah, so it can get out of control pretty fast.
It can.
He got out of it. Yeah. And then so you had a podcast too. Like what was the impetus behind that? Tell us more about the podcast and how what you learned doing it. I'd love to learn from other podcasters, and then also how it kind of informs what you're doing now. And then and it sounds like you're not doing it anymore. So why'd you stop?
Well, my original podcast was called Get It Done, and I was doing it. I started it basically during COVID. It was a way to connect with people. And what I realized though in doing it is like I wanted to do it as a way to just a unique way to make a connection with somebody, right? Networking was kind of dead in the moment. I wanted to, talk to other business owners, put out content. And when I first started doing the show, it was mostly just around like, how can I put out cool content? And then I realized after doing a handful, like this is a really cool way to connect with somebody, right? And a lot of the time, let's say I'm hosting a podcast, but I'm having a guest on who's a business owner. That might be their first podcast, if not maybe second. But like, so to them, once they come off that show, like I'm the only guy that they in their life that's ever had them on a podcast. So that's like a unique relationship that you've built with that person, right? So I found in doing it that it's a cool, unique way to connect with somebody. It's almost like going and grabbing lunch or a beer, but you're opening up and telling personal stories like right off the jump. And so when you leave, you're like, hey, we just built something kind of a little bit of a start to a relationship. So fast forward, I did about 100 episodes just because I got like addicted to it when I was doing it and then when I sold the company, I kind of just stopped doing that one for whatever reason. And I just recently started up a new podcast, honestly, for the same reasons. It's called Behind the Deal. I haven't released any episodes yet, but I've filmed like 8 of them. And this whole show is all about M&A, right? Like the stories that go into it, what actually goes into getting deals done, real stories, challenges, wins, you name it. and I'm trying to, speak to M&A professionals, right? So it's people, whether it's private equity, family office, or just operators who have grown their business through M&A. Those are the kind of guests I'm looking to have on. And again, just build a cool relationship with them, right? And reaching out instead of saying, hey, I help people like you find deals. I'm like, hey, you want to be on my podcast and talk and get to know each other a little bit, and we operate kind of on a national level too at DealGen. So I can't go get coffee on a Wednesday with a guy from Texas, but I can do a podcast with him like this and get to know him a little bit. And then he might say, hey Joe, I'm looking to buy commercial roofing companies around the southwestern part of the United States. Like, have you seen any deals? And maybe I have, right? And that's the start to a business relationship too. So that's why I, enjoy podcasts, a unique way to build a relationship with somebody. And like I said, to them, you might be one of one. So like every time they're like, they're pretty thankful for that relationship. They're like, wow, no one else has ever invited me to a podcast.
No, I love doing the podcast. I started it because I went on someone's podcast. I had that experience and I was like, oh, this was a lot of fun. And, I think people just generally like talking about themselves and being interviewed. I was like, I should do this for my founders, so I started having my founders. And then I was like, oh, I have VC friends. And then I have people like you, like in the network that are kind of adjacent and partner with us. And I think it's been an awesome way to build a relationship because I'm way out in rural California. Like I'm 2.5 hours away from San Francisco, right? So I try not to drive in. I get sucked in almost every week. So I do go down like once a week, every 2 weeks. But, it's a great way, like you said, and my founders and VCs and LPs and partners are all over the nation, all over the world. It's so easy to build a relationship this way. And I'd love to get your thoughts. Do you prefer doing a podcast or would you prefer to go to a networking event?
I mean, I would definitely rather do a podcast for sure.
100%.
And I would rather sit down with, let's say I can go to a networking event where there might be, 50 private equity funds. Like I can do okay in that room and I can, hang out, I'll talk to some people. But at the same time, like, would I rather try to build a relationship like this with 5 of them? And like get to know them, get to ask them the questions that I'm interested in and hear their response and have them ask me questions. And instead of,
I don't even like to go to networking events anymore. Like, I'm just like, I don't want to go. I'll go to speak.
I hate it.
Like that. Like people invite me to like events. I'm like, if I'm a speaker, I'll come, but I'm not just going to go stand in the crowd and talk to people,
Yeah. I still try to go just because I feel like it's something that like, as you're trying to, in my position, as I'm trying to build a new business, like I should get out there and meet more people. But, for me too, it's changed since I've had a daughter. Like, I'm just like, I'd rather go home. It's like a Wednesday night. Like I'm driving into the city.
Yeah. Oh, you have little kids, like, right? Yeah.
I have a 2-year-old. Yeah. And I'm like,
right.
I could drive into the city right now and, it's going to take me an hour to get in there. I'm going to have a couple of drinks and then
you're not going to get home. Your daughter's going to be sleeping.
I'll be home till
you missed
10
the
or
whole
11.
evening.
And then, I'd just rather go hang out with her and,
yeah, better yet, send me the attendee list and then I'll just like go look through and invite the people I want to talk to on the podcast.
Yeah.
I tell everybody I have a podcast. Like, what would you do a podcast on? And they're like, I don't know. It's like, well, what are you interested in? Like, I think everybody should have a podcast about like whatever crazy niche that they're into,
Yeah. Well, it's a cool way to learn. It's a cool way to talk about what you do. It's a cool way to learn about what other people do. And like in this world of PE, right? Like I don't come from this background. I operated a business that I started out of college that had nothing to do with private equity. So I've built the network that I have today from scratch. So when I see that and I'm like, all right, well, I've gotten this far without knowing anybody. How can I continue to build on that, but also do it in a way that I like enjoy and in a way that, I can cut up and make cool content out of and, maybe become a little bit of and in no way do I want to be like an influencer, but like a voice in the space of PE by putting it on LinkedIn and stuff like that. Like sign me up for that. That sounds cool.
I like being a mini celebrity inside of VC, right? And I'm not even there yet. Like I'm not like a Jason Calacanis or anything. Like I go places and people are like, oh yeah, I know Ignite. I know your podcast. And like, I'm like, cool, thanks. But I go to a grocery store, nobody gives a shit who I am. And I like it at that level,
Yes. Yeah. I mean, hey, if you're getting asked to speak at certain events, you're doing something right and people know who you are. I'm still climbing up that mountain.
I don't like public speaking either, but I power through it. I like the podcast format because it's just you and me hanging out, even though we're like being recorded and thousands of people will probably, tens of thousands of people will probably see this video and the clips from it, but it's fun.
It is fun.
And somehow I'm way more nervous in front of a room of like 100 people or like 1,000 people. I went to a conference in Hawaii and I spoke in front of like 1,500 people. I was like, oh, that's a lot of people. That's like way more than I expected.
When you look up and see all those eyes, you're like, whoa. Yeah.
Oh, that's a lot of, lot of people out there.
You looking at me. Right. Oh yeah,
So let's
it's
get back to
intimidating.
deal gen. So you're on the buy side is how you would characterize that. Maybe you could tell the audience what
Yes.
like buy side and sell side means in this industry.
Yeah, so it's almost like, I guess, a space that relates to more people than private equity would be real estate, right? On the sell side, you have a house and you're looking to sell that house. So you hire somebody to help you market and find buyers for that house. So, they put your house out there on the internet, buyers come and visit and do an open house, and then you get a bunch of offers and hopefully you accept a good one. So that's like the sell side. You have a company, you hire somebody to help you sell the company. On the buy side, it starts the buyer. There's a buyer who wants to buy a business. So they hire us to help them go find those targets. And, they do it for many reasons. Some of the bigger funds do it because they want to dominate coverage across the industry. Like they have their own internal team, but they want to make sure that they're talking to everybody. Some of
We're
the
plugging
smaller
feature
funds do it.
gaps in the platform. Like we have a marketing platform and we don't have this tool. We don't have an SMS tool. So we're going to go try to find one, something like that.
Right. So people will hire us for a couple different things. One will be to buy what's called a platform company. So that will be their first acquisition in a new space. So it's someone who, a fund, they raise the money, or an independent sponsor who has a thesis and they're like, hey, I'm going to go buy a dental company. And because I have a strong thesis in dental, we don't already own anything in dental yet. I'm going to go buy that business. We'll help them go make that first dental purchase, and the way we normally do it is we'll build out a list of proprietary targets that meet the qualifications that they gave us. And then we'll just reach out to them in a million different ways until we get as many qualified contacts as we can. That's a very simple way of talking about what we do. But then there's another strategy where someone will already own a business, a dental business. They bought the first one, right? And now they're like, hey, the best way to grow this from here moving forward is to just buy more of them and roll them into what we already have, the existing infrastructure. So someone might come to us and say, hey, I want to buy 5 more dental practices that are, within 100 miles of this one that I already own. And so then, we'll build a list that matches that criteria and kind of go out and do the same thing, right? There's different ways that we operate within that ecosystem. And again, there's different reasons why we get hired, right? A bigger fund might hire us to get more coverage and maximize their coverage. In a smaller fund, if you're operating, within a private equity fund, or even if you're an independent sponsor, which is a group who is looking to buy a business, they don't have a committed fund yet. They have people who will help them buy that business, capital partners that have committed, but they haven't raised a fund. So an independent sponsor is, again, it's the same practice though. They're going to try to go buy a business. They might hire us because they have a smaller team and they're wearing, 10 different hats, right? They're the ones who have to go out and find the capital and build a relationship with capital partners. They have to do the diligence on the businesses that they're going to buy. They have to, help the operations of the businesses that they already own. They don't have time to source deals, right? So they hire a team like us to make sure that that deal funnel is always on and that they're always seeing new deals, and so that they can kind of make sure that everything else is running smoothly. So we get hired for different reasons. We get told to search for different things.
I would imagine you're using like Zoom Info and Sales Nav. Like, are there any other tools out there that are really useful
Yeah,
for
we
you right
use,
now?
a combination of Zoom Info, Apollo, Sales Navigator is a huge one. We use, email marketing and LinkedIn marketing tools like Lemlist. We'll use, cold calling software where we can, auto dial 4 or 5 people at a time. We will even, sometimes do handwritten notes, right? We'll have we have a group that we work with who, has those machines that write the handwritten notes, and it just depends on the campaign, right? So most of the time we'll come in and we'll structure a multi-channel campaign, that will blend a sequence of cold calling, emailing, and then LinkedIn marketing, right? So we'll connect with those people. That's the base of the campaign, and it might be 7, 8, 9 touch points across 3 or 4 months. And then we'll monitor it. And if there are certain things that don't work, like I'll give you an example. We did a dental campaign, and dentists, people who own dentists, are also usually the ones who are the dentists. So they're brushing teeth all day and they're filling cavities. They're not at their desk. They're not answering the phone. They're not answering emails. So those strategies don't work. Calling them and emailing them is very hard. Like they're getting the responses is almost possible. It's the same with like a law firm, right? Those people are in court most of the time. So, sparingly are they just sitting at their office answering the phone. So you have to try to get to them in different ways. So like with the dental thing, even though tracking their ROI on handwritten notes is pretty hard, we found like, hey, let's just start deploying this strategy because it's a way to get in front of them. And turns out, we got some responses to those notes because, their secretary or front office person would get the mail and they'd put it on their desk and they'd get it from us. And it was different, and they could, look at it and mull it over at the time. That might be 8 o'clock at night or 6 in the morning. But we try to monitor each campaign that we're running and then adjust towards what's working, or even adjust away from what's not working as frequently
Yeah.
as we need to.
Is this success fee based? So almost like a real estate broker, they're paying you a success fee for finding the business, and you get a percentage of the outcome.
Yeah. So our typical structure is a retainer plus a success fee. And the retainer is based on the amount of contacts that person wants us to go after, right? So that might be 200 companies or it might be 800 companies, and based on the amount of contacts that we're working, that's usually what fluctuates the amount of time that goes into this and the amount of costs that buying more contacts is more expensive. All those things, working and calling and emailing and doing all those to more contacts is more expensive. So, but the tools and the secret sauces of every campaign remain the same. So it just fluctuates on contact. And then the retainer is usually a monthly fee, and it's a 4-month commitment for most of our campaigns with month to month thereafter. And then there's a success fee based on the size of the company, right? So, if they buy 100% of a $10 million business, our success fee might be anywhere from 1% to 3%, depending on the agreement that we made with that fund or our relationship, our history with that fund. We also, what we try to do, and it's common in the world of buy side deal sourcing, is most of our funds, they don't mind if we send them deals that are already on the market, right? So those lists that we're building on behalf of the fund are usually all off-market opportunities. But we have a network that we've built of over 10,000 intermediaries and deal sources, investment bankers, advisors, CPAs, you name it. And those people might be representing clients that have deals that are just on the market, but they fit what our client's looking for. So we'll ping that network over and over again for each of our clients, letting them know, hey, we have a client looking for car washes. And usually that returns a decent amount of opportunities, but we'll take a lesser fee for finding them an on-market deal than we do if we find them a proprietary off-market deal. And that's just because there's some strategy to that too. It's not just because maybe it's less work or something like that. It's really because if the deal's on the market, usually it's going to be competitive, and that buyer also needs to be competitive if they want to win. And so, we'd say, hey, if we'd rather people win deals and close deals, right? For a number of different reasons. It's how we get paid, but it's also how we build a good reputation. So if taking half the fee helps them put more capital into being able to, raise their valuations and win that deal, then that's fine. That's fine with us. Usually, again, to kind of back to your original question, there's a retainer plus a success fee, and they can fluctuate, depending on the situation.
Yeah. How are you guys keeping track of all this? What's your CRM solution for that?
We use Pipedrive. There's a number of different ones out there. Pipedrive, I found to be the simplest of the tools. I think it has a lot of the bells and whistles that the other ones do. I actually have never used Salesforce, believe it or not, but I have used
It's too
HubSpot.
clunky for you. Yeah. It's really good for enterprise, like software people, but yeah.
Oh yeah, I mean, there's no doubt the tool is amazing. Does our organization need it? No, probably not. So we use Pipedrive to track everything, and then usually live in the Google environment too. So the lists that we build, the marketing collateral that we build for each of these funds, all lives within a Google folder. And then as we find them deals, we'll build out that folder with like, hey, this is an opportunity that we sent you. And our team actually goes above and beyond. Like, we don't just flip over, hey, I booked a call with so-and-so for you. Like, what we try to do is we'll have the initial conversation, if not the initial few conversations with the seller. We'll get to know them. We'll get to learn, about their business. We'll get to confirm, how big is the company? How much has it grown year over year? Try to get those initial qualifying statistics for our buyers, and try to dequalify opportunities on their behalf so they're not wasting their time. But then once we've qualified something, we'll ask them, we'll do a basic information request. We'll try to gather that information into a folder, and then we'll share that folder with our client. So we'll say, hey, we found you this. Here's a highlight of what the opportunity looks like. Here's a folder with the information we were able to gather. If you're interested in going down the road further, well, we'll book a call with you and that seller. So yeah, everything kind of lives within Google. And then the Pipedrive is what we use to kind of track where opportunities are at. It might be qualifying call, and then the next round might be, data gathering, and then call booked with fund. And then, it moves all the way down to hopefully closing a deal.
Are you guys doing mostly this kind of SMB, dental roofing company kind of M&A, or do you guys also do software company M&A?
So we built our business in the software space. So our first ever client was buying distressed software. So for that reason, our first like 5 to 6 clients were all software buyers because again, we were finding different deals all in the software space. And then if they were a pass for our existing client, we'd put them in a folder and show them to a new fund and grow our client base that way. And we've expanded since. So I would say this, we're usually operating in the lower middle market, meaning companies that are, anywhere from 5 million to call it 200 million of enterprise value is where we play. Below that would be kind of like micro or just really like micro business. Believe it or not, even though they might be 2 million in revenue, like that might be a micro business. And then small, medium is where most of our funds are shopping. The areas that we're usually searching in are software, business services, industrial and manufacturing, food and beverage, and in some cases something like a car wash where that would be, I guess, more like a consumer service. We've done things in dental, which is would be more considered healthcare. We did one like surgical search, way back, kind of 4 years ago. That was an interesting one. But again, more dental. We don't do a ton in healthcare. We don't do a ton in like biotech. We don't do a ton in, we don't do really anything in like kind of newer industries like cannabis or crypto or anything like that. It's mostly like software businesses and kind of old-fashioned business services and industrial type companies. And for the most part, our buyers are looking to purchase a majority stake of the business. So we're not doing any like venture rounds, Series A, Series B, any of that stuff like seed funding. It's all people who guys who are looking to buy the company and own a majority stake in it.
Yeah, these are PE firms or funds, search funds that want to buy the whole business for whatever reason, whatever strategic reason, not, write a $10 million Series A or B check. So if you have a Series A or B funded startup, how are you guys advising on valuation? Do you have an equation? Is it discounted cash flow? How are you coming up with the enterprise value of these? Like, let's just take software, for instance.
Yeah, so most of this, I'll be honest with you, a lot of the software buyers that we have like to be the first institutional capital, if at all possible. We've definitely worked on searches before where they don't care, if they're like, if they've been funded by a venture group or anything like that, but they'd prefer to be the first institutional group in there. But
why do you think that is? That's interesting. Yeah, why do you think they prefer that? I think I know, but like, I'd love to hear your answer.
Well, honestly, my answer is that I think that they can get the terms that they want, right? And they could likely buy it for a lower price, and they can likely get
you got a VC on the
terms.
board. They're going to be like, no. Like, this company's growing at 3x year over year. It's worth 100 million. And you're like, well, like, that's not my price,
Exactly. And with the VC, if they have a VC and someone approaches them to buy them, you also get that VC's attorneys and those people who are kind of behind them who can mold the deal to be different than if you didn't have them on your cap table. So I think
so
that's
you prefer bootstrap
kind of a reason.
founders, basically. Yeah.
Right. But back to your question about valuation, for the most part, software is getting valued off of the recurring revenue from what I'm seeing. So obviously there's a preference to have it be profitable. I shouldn't say that. Our first ever buyers were distressed software buyers, right? So they would still value the company off of their ARR usually, but they would usually give like a 1x valuation. So if the company was doing 8 million of ARR, but last year they were doing 10 and the year before that they were doing 12.
That's distressed. Yeah.
Distressed. And in that distressed situation, our buyer might come in and say, we'll give you 4 million or 8 million for it just to get you out of that situation. But, if it's a growing, profitable piece of software that kind of solves, it's a vertical problem, right? It's it could be a sales enablement tool for small and medium-sized businesses. So it's like it has a niche market and it solves a niche problem. Those are kind of like those are the most desired businesses for most of our software buyers. And from what I'm seeing these days, that type of company might command a 6 to 7x multiple, maybe upwards of 8. And then as they go up in size, if that was instead of doing 6 million of revenue, they were doing 20 million, 30 million, they'll get a higher multiple. And then, as they continue to climb, they'll get a higher multiple. So a lot of those software companies, from what I'm seeing is, they're buying them, they're paying a modest recurring revenue multiple. And then their strategy is obviously to take that $6 million company, turn it into a $30 million company within 5 to 7 years, and then sell that $30 million company for $300+ million, right? Or $400, $500 million. So you can get that multiple arbitrage and you can create, that long-term recurring revenue. by, again, buying these companies from maybe a more bootstrap founder who has just kind of peaked at how far they can take them with their existing resources, and taking them under your own wing and deploying your resources, your capital to continue to grow that company.
So let's take three situations. I'd love to get your opinion. So take that same software company, and let's imagine one just tripled to 10 million. So they're 3 to 10, 3.3 to 10. So they're really off to the races, right? And they're getting an offer to buy. And then there's another one that just 2x. They went from 5 to 10. And then there's another one that grew 50% year over year. Call it whatever that is, 6.6 to 10.
Mm-hmm. Mm-hmm.
What do you think the multiples are in those three different situations for an exit for that founder? Or what were your buyers be willing to pay?
Yeah, I mean, it's funny you ask. So someone who went from 3 to 10, interestingly enough, unless that company's been around for a while and they just had like some crazy year, that's hard growth to evaluate. Because, if they went from 0 to 3 to 10, they obviously are doing something right, but that's like a hard thing for our guys to evaluate. And honestly, in many cases for a private equity fund, that could be like growing too fast. And that person should probably go out and
There's
maybe
no
raise
arbitrage
venture.
there for them. It's like you should probably go get more venture capital and keep growing the business.
Get more
basically.
venture capital and keep showing that you can grow at the pace that you're growing, right? That might not even be a private equity deal. So because I don't really deal with those venture situations, I actually don't really know what that would be valued at. But I would think that it would be more venture.
That's a good answer. I would say in venture, that company's getting if it's an AI company, they might be getting a $200 million valuation right now.
Yeah.
Or 100 for like a Series A, call it, or maybe a Series B.
Right. And that's, that would be definitely more in your ball field than it would be mine. But
well,
I could see that.
That'd be one of my companies I backed when they had, almost zero. Hopefully.
Right. Hopefully. Yeah, exactly. The company that doubled from like 3 to 6, I think that, if they've shown some steady growth and then they had a big year, they signed some new clients, they, just were able to gain some traction. I mean, I think that company should have no problem getting close to $40 million of evaluation. I think
on a 6, not a 10, not from 5 to 10, but a 3 to 6, you get like
I think a 3 to 6 would command close to
6, 7x, 8x, somewhere in there.
Yeah, 6 to 7x, I think would be realistic.
Yeah.
But at the same time, wouldn't be surprised if it also landed on, hey, we'll give you, 5x with some sort of earnout, or, let them roll equity, right? And say, hey, maybe they'll buy 70% of the company for, a total valuation of like $35 million.
I want to come back to the earnout, but I want to finish the last one, and then we'll come back to the earnout. The last one where they didn't double, but they grew, call it, 40, 50% year over year.
So they went from 3 to, 4.5.
Something like that.
That's still a pretty healthy company, and honestly, if depending on what kind of problem it's solving, I wouldn't be surprised if, you could go to market looking for between 20 and 25 mil and for the, enterprise value. But again, someone, for both of these situations with that type of growth, especially in software, I think that it would be in the buyer's the seller's best interest, if they're going to sell to private equity, to retain as much equity as they can. So sure, sell 60, 65, 70% of the company, but you've been growing like that. Now you're bringing in someone who likely has a background in the success stories and growing and selling these software companies again. You could you could put 10, 15 million bucks in your pocket today, keep 30% of the equity, help them go from, 5, 6 million all the way to 30 million. And then that 30%, when they sell for 300 plus million, that you're going to make more money from that 30% than you did the first time you sold it. So getting like in those growth strategies and those growth stories, if it's never a bad, I don't think it's a bad time to sell, especially right now. I mean, people for a long time have been saying like, oh, software multiples aren't what they used to be. I think for a while there, they got a little out of whack, and now they're coming back down to reality. But if you have a good company that's growing, there's not a lot of companies out there that are selling today either. So they're actively looking to sell. They might be waiting for some sort of multiple to come back. But if you put that thing on the market, there's a lot of buyers out there looking to buy. So it's just there's a supply and demand difference. So you put a good, healthy, growing company on the market, you're going to get a lot of attention. You're going to typically be able to kind of command, a pretty good valuation, just because you're the only one at the dance and these guys want to deploy capital. And you should think about picking the right buyer who will be able to take you to that next level, and really think about hey, I can put some money in my pocket today and be financially free. And then if I help them grow this thing, I can be truly wealthy, because when they sell it, I'm gonna do really, really well.
So this is really interesting. So let's unpack a little bit. So we just talked about valuation, enterprise value, kind of the sale price of the company. There's all these other terms when you sell a company that we should unpack. One of them was the earnout. One of them was like how much equity are you keeping in the new company or the post purchase. Let's talk about earnout. Like what are typical terms you're seeing there for a founder that they should know? Like what feels market, what feels aggressive, what feels conservative. Like if you're for the founders listening out there and they have an offer, what should they expect?
Yeah. Well, for the founders listening out there, here's a bit of advice, right? You have to really think about before you go to sell your company, like what is the result I'm trying to achieve, because that will help you formulate the story you want to tell, So if let's say, for example, you're not super sure about how much more the company can grow, but you've grown it pretty well over the last few years. You don't want to go to market, pitching that like this has this tremendous growth story in front of it necessarily, because if you say like, hey, I know how to grow this, all we need is more capital and we can really blow this thing up, a buyer is going to come back to you and say, okay, well, I'll give you a $20 million valuation on your $4 million company. I'll give you 10 million of it today, and I'll tie the other 10 million of it to an earnout. And an earnout is if you hit these certain metrics, like 25-30% growth year over year for 2 or 3 straight years, you'll earn that other $9 million. So where I'm going with this is depending on the situation you want, like if you're thinking about retirement and you're in your later 60s, an earnout, your best hustling years are probably behind you. So an earnout isn't that attractive, because that means like you're going to have to achieve probably pretty aggressive growth over the next 2 to 3 years to make more of that money. You would rather more money up front and less equity. If you're a younger founder who believes in the product and thinks that like there is a lot more room here on the table, and you might have some tricks up your sleeve, right? Where you're like, hey, I know that it's October. I know that in January, like one of my biggest clients is going to renew for twice as many users as they did before. So you can kind of forecast like in a way, like, hey, I know this is going to come in, so I know I'm going to have no problem meeting those metrics that they put in front of me later. So I might accept, an earnout, but I think you want to just be careful as to not be too aggressive with the growth, right? I've seen situations where a company has, if you're the person selling the business, so you're a business owner, you've grown comfortably 10% year over year. Now a buyer comes to you and says, hey, I'm going to buy your company. There's going to be a 3-year earnout, and you'll earn the rest of your money if you guys grow 25% year over year. Like that's aggressive, and that's like you can look at that and be like, I mean, yeah, maybe with your help we can, but at the same time we've also never done that before. So how am I supposed to say yes to this, right? Like let's keep it more conservative. The other thing too is that, and I think there's a lot of studies on this, earnouts are the way for a buyer to put a deal in front of a seller with a high top number, right? Like, oh, my company got bought for $20 million. Yeah, but you had to earn 10 of it. I think a lot of the times sellers would prefer if someone just came to them with a much simpler thing, like, hey, I'll just give you 15 million today.
Walk away. Bye. Yeah.
Walk away. I know the number is less, and I know the headline doesn't read as cool, but you get to get $50 million and just leave. And like I find that sometimes the simpler the deal terms are, like the more attractive they are to that buyer in the long run. Especially also if they have like a sophisticated banker in their corner who understands like, hey, this earnout looks cool, but like I don't think like let's look ourselves in the mirror and have an honest conversation. Do you actually think you're going to be able to achieve that? Because if you can't, then this is not a deal we should accept. So I know I kind of just rambled there, but
No, that was great. I learned a lot.
I've dealt with it before. With those earnouts.
Yeah. So putting on the the buyer side here, I know you're mainly sell side. You're the investment banker for the seller. How would you advise them to, so you get this 10 and 10 earnout thing and it's probably not achievable? What's your counter? Like, do you counter with like, how about just 15 and clean? Like, and I walk away after 12 months basically, or does it usually come down to something in between that?
What you try to
let's,
do,
let's say the seller is willing to do the earnout. They're like, I'm willing to stay 2 or 3 years and make some more money. And I do believe that I could hit like a reasonable target. Like, how do you counter? You just kind of come back with the terms you think are achievable, or?
I think you always try to get as much of the cash as you can up front, right? Because as much as you might believe in the company, as much as the partner has a good track record, I would advise most people to go into those situations happy with the number that they're putting in their pocket when they sell the company. Like if you're like, hey, if all I ever make is 12 million bucks here, like I'll be okay, right? Versus being like, no, I'll take 5, but I have the opportunity to earn another 20. So what we try to do all the time is advise people to push the cash at close as far as they can. And then from there, we would lower those, try to work towards lowering those earnout expectations, right? And maybe with lowering the expectations comes a lower valuation, but it's more achievable. Again, a company that's only grown 10% for the last 5 years, if their earnout is 30% growth, like the idea that that's achievable is pretty far-fetched. And I understand that they're bringing new capital and partners to the table, but at the same time, this person just the person in the company hasn't had a history of doing that. So like, it's really hard to make that jump. So we would try to lower those expectations down to like, hey, why not? We have the ability to earn a little bit less, but if we just continue to hit this 10% growth year over year until 3 years is up and we're out of here, shouldn't that count for something? So we would advise them, we would try to get them more cash at close, and we would try to get them more realistic earnout expectations. And then it just really comes down to, are they comfortable at that number? Is this the best situation for them, right? We're dealing, I've dealt with this with a founder who's 65 years old before, and he was gung-ho. He thought he saw a lot of opportunity in the future for the company, but in reality, the company has been flat for a while. Not that it was a bad company, it just been flat for a while. And this guy, he had grandkids. 65 is like, you can go, like, you should be thinking about those things at that age. So it really came down to like, hey, wouldn't it be nice to just put a nice chunk of change in your pocket right now and not live the next 3 to 5 years with a lot of stress? Because like,
Trying to hit
yes,
your
you
numbers.
might be able to, you
Yeah.
might be able to earn another 10 million bucks, but you also might have a heart attack trying to do it. Those real conversations come out a lot of the time when you're talking, like when it comes to nut cutting time on selling a business, like that's when you have real talks about like, dude, this is just not the right move.
Yeah. I worked at a startup. We went through a sale and it was about 1x revenue, I remember, because we were kind of flat for a while. And we all had earnouts, like all the senior employees and executives. And, people started dropping off when it became clear we were not going to hit our numbers, because you have like, this chunk of money dangled this carrot and you're like, okay, we're not going to hit this number. So you just see people just starting to leave.
Yeah.
Month after month. And
yeah. I mean, the earnout game is, I think the professional buyers, they know how to use that card. I would say ultimately, you'd rather have a clean deal where you understand exactly how much cash you're getting today. And if you're rolling, so an earnout is you have to earn the money that's left on the deal. An equity roll is this buyer's now buying 70% of the company, 75%. But you get to retain ownership still. So you could say, hey, we're doing a $20 million valuation to buy the business, but we're buying 70% of it, right? So, you're going to get X amount up for $14 million today, and then you're going to keep 6 rolled. And now you basically just brought in a new partner who hopefully can, you put some good money in your pocket now, and then you can turn that 6 million into a whole lot more by, retaining ownership, right? And so the difference between that and an earnout is that like now you're growing because you still own part of the business. Usually an earnout is done when someone's buying 100% of the company and you have to earn more of the money that they're going to give you by hitting numbers. And so in some cases, it's definitely worth taking that deal again if you believe that you can achieve those goals. But in other cases, it might be best to just try to tighten that up and take the money and go do something else.
What other kind of term sheet things are common that we should discuss in these sort of transactions? You mentioned a new one, which is the equity roll. What else should buyers and sellers be looking at?
I mean, some people want you to like seller finance a deal. That's a huge term that's being thrown around these days, usually in smaller businesses than what we're dealing with. So like, for example, there's a huge push online right now of like people telling, other people on LinkedIn or Facebook or Instagram that you can buy a business with zero money down. And obviously, there's a possibility in doing that, but I think it's a very crowded, like not super informative space. It's just like people
sounds like
saying
all the real estate guys, go find distressed homes and get seller financing. Yeah.
Right. What they don't tell you is that if anybody's selling their business with zero down, like that business is usually probably a mess, or there is really not much of a business there. But seller financing would be, again, someone agreeing on like, hey, I'm going to buy this business for $10 million. I'll give you 5 of cash, and then I'll give you 5 in a 5-year note, right? So that would be, so now the seller is essentially saying like, I'm not keeping my 5 as equity. I no longer own any of the business. I've sold 100% of it, but I'm giving the company a 5-year loan, and they'll pay me back in monthly installments with interest. So they might say, hey, I'll give you a 5-year note with 10% interest. So then at the end of that 5 years, that person's maybe made, 11 million bucks or something altogether, right? And they've collected monthly payments. And, there's a time and a place for that too. I mean, that's not the worst strategy, right? If you look at your life as a business owner and you say, hey, I can put a chunk of money in my pocket today, and then I can still earn this much money every month, through this sale, if that amount of money like covers your life expenses, that's not a bad deal, right? You're kind of just locking in income for the next 5 years. So, and usually, obviously, that number that they're throwing out there is a number that the buyer can support through the business, right? So like they would only do that if the cash flows of the business can support that loan. Otherwise it doesn't make sense to take out debt to do a transaction like that. So that's another term that's getting thrown around a lot. I don't see the sophisticated private equity buyers use it as often as I see, maybe like the search funds of the world, or the ex-executive who's looking to buy a business because they want to get out of, their 9-to-5 job. Those are the people that are usually using the seller financing more. But at the same time, seller financing is not, if you're a buyer and you can get a seller to agree to seller financing, it lowers your barrier to entry to buy that business by a lot, right?
Right.
Because you can
Yeah,
say,
you got to come up with less
hey,
cash, and then sometimes for a seller it's good for them because like you said, it creates this annuity, and then you have a lien against the business.
And
if
you
things
might be
go
able to finance
south.
some of it. Like you might be able to go to a bank and say, hey, I'm buying this business for 10 million. The seller's rolling 5. I can come up with 1 or 2, and I need 3 million to close the gap. And you can show them like an underwriting of, hey, like here's my spreadsheet that supports that the business can do that. Versus if you show them a spreadsheet that said, hey, I need $7 million or $8 million in order to close, that bank might look and say that's too much risk for us. If they only have
The
to
bank
come up
might
with
take
3.
that loan if they're senior to the note as well.
Right. Yeah, and again, that's a term that I see a lot on LinkedIn and Instagram. I don't see it a ton from our PE buyers, but for whatever reason.
What else? Any other terms we just should discuss, maybe from the PE buyer side?
From the PE buyer
Or did
side,
we kind of beat that horse to death?
we beat it a little bit, but at the same time, there's other things that get thrown around in a deal, like working capital. It's basically the private equity fund is agreeing to fund the future of the company with a certain amount of money, and that number actually might get negotiated, as I've seen it work on both sides. Right? Either the buyer's coming up with that number, or they're negotiating it as part of the purchase price, where they're saying, hey, we're going to leave $1 million in here.
Yeah, we're going to buy it for 20, but $1 million of that's coming off the top and going into working capital for the business,
right,
kind of thing.
Right. So the working capital is just, how much money do we need to sustain the company as it is today, and to, and sometimes also growth is factored into that number too. Like how much do we need to deploy in order to kind of hit those growth projections that we have? So that's just another term that, will get thrown around if you're in the middle of trying to buy or sell something. And that's something that, again, if you're rolling equity, and you're maintaining some sort of ownership, that number is really important to you, because you're like, hey, we can grow, but like if you guys suck all the money out of this thing, then like we're never going to grow, Or if you have an earnout metric and you're like, all right, I have an earnout, I have to do 10% a year for 3 years, but like you guys aren't leaving me any cash to do that, like that's something that you have to consider, right? How much is that working capital and where is it coming from?
Right. Yeah. So you're also a partner at Bullpen Technology Partners. Maybe you could talk about what the vision there is and how does that complement DealGen?
Yeah, I'm glad you brought that up. So Bullpen is an interesting opportunity that we had. So Brian and I have always been looking for, a way to get deeper with some of these funds that we work with, right? Finding them deals is great, and it's something that they need, and it's a problem that we're solving. But these guys, a lot of the time, they have tons of portfolio companies that are worth tons and tons of money. And it's like, how do we get a little bit more entrenched? How do we add more value to what they're already doing? So forever, we were thinking of different ways. Some of them made sense, some of them didn't. We got the opportunity to purchase a small business, which is now Bullpen Technology Partners. And it was through one of the deals that we were doing, right? So Bullpen's an IT consulting company. And it's, essentially think of like within the four walls of a building, like all the IT that might go into, running companies there, the phone systems, the internet, the security systems, the cable connectivity, whatever it may be. There's like 19 to 20 different things that might. So we were helping a guy, we were helping facilitate a deal where a buyer was buying one of those businesses, and they had a non-compete with a certain list of clients that buyer had. Like they were like, we're not interested in purchasing this little chunk of business from them and like factoring that into the valuation because we can't, ultimately do any work with those clients. So there was just a pool of clients that were sitting there. So we made a deal with the seller, like, hey, we'll buy them from you, right? So we'll, and again, there was a little bit of seller financing that went on in there. It wasn't a big business, but it was, what we saw was, again, all of these private equity funds that own these brick and mortar businesses. This company that we bought came with licenses to resell certain technologies where, we'd be able to save these companies, 20%, 30%, 40% on their IT spend. So I'll give you an example for like, the car wash group that I mentioned. They have 40 locations. Within each location, they might spend $2,000 a month on IT related things. So if I can come in and say, now with Bullpen, I can say, hey, let's do an audit of your existing IT infrastructure, right? And what are the different bills and what are the different expenses that you're paying each month? And then what do those contracts look like? And I can bring in a partner, a big partner that we use that we've grown to really like. And these guys do like every Walgreens in the country, every, Marriott hotel. Is a group called Velocity. Velocity, has like 19 different solutions that they provide from an IT standpoint. So we can work with them to do an audit of a company like the car wash, and we can come back and say, all right, you guys are spending $100,000 a month on IT. We can get that down to $75,000 a month. And over the course of a 3-year contract, that might be very, very meaningful money. Not only can we do that, but we can condense all of your IT solutions onto one platform, right? So whether you need to call, the guy who's providing you Wi-Fi, or whether you need to call, the cybersecurity person, or whether you need to call the TVs that are in your lobby, if those go out, all of those bills and all of those solutions will be on one platform. And if you need assistance with any of those things, we're going to provide, a one-stop shop for you to be able to call one number and have boots on the ground to go fix any of those problems, right? So they're still getting their Wi-Fi and things from groups like Verizon, but everything's funneling through Velocity. And where Bullpen Technology Partners sits is, we're just an outsourced IT consultant. So we bring in a company like the car wash, we introduce them to Velocity, who's our partner. Our partner provides those solutions. And then Bullpen, the way that we get paid isn't actually from the company. Our company gets compensated by a group like Velocity, the provider. So for bringing them new clients, we'll get a piece of the monthly, save that we're able to get. So for us as entrepreneurs, it's nice because our business at Dealogen is pretty chunky. We get big hits when we close deals, but for the most part, it's, there's waves. And this is healthy recurring revenue. And it's a way, again, to really solve problems for our businesses. So now that car wash owner, not only have they reduced their spend, but they know the next time they go to buy a 10 car wash portfolio, that they might be able to save, 10, 20 grand a month on the IT spend that those car washes are doing. So they can, in the back of their mind, they're like, well, day one, when we buy this, we're going to be able to cut these costs by so much. So that was the type of solution that we were looking to provide these guys, and the opportunity presented itself to do it. So we jumped.
So I don't think any founder starts a company thinking like, I'm going to sell someday, or they shouldn't. We definitely wouldn't invest in them. But what should founders be doing now, even if they're years away from selling, that'll make their businesses more attractive to buyers in the future?
I think that it depends on what industry are we talking.
Let's take software. This is mostly a software podcast, but you could take it both ways. You could do software and then a SMB.
Yeah, for software, I would say, again, like from what I know about what our clients who are the end buyers want, they want, a software that's going to solve a vertical problem, so like, again, like it might be I use this because it's a real example that we're working on. A sales enablement tool. So a tool that can help medium-sized businesses increase their sales by connecting it to their CRM, right? So it maybe can enrich the data within the CRM. And now these medium-sized businesses are operating out of a much cleaner CRM, and it's a sticky product, and it's recurring. And, once it's kind of embedded, it's sticky, it's hard to move. So that type of, I would focus on solving a solution that, again, you can say, hey, we have 100 clients today. There are 20,000 medium-sized businesses out there that we could be going after. So if we, that way you can now tell the story of like, we have a direct target market, and we have a TAM that's real. And then I would say, focus on, ultimately the things that matter, even if they're not trying to sell, like the metrics that matter are still kind of the ones that they should be trying to hit, right? Like growing their recurring revenue is a key thing, and inching, if you're going to be, that next AI company, I don't know a ton about how those companies operate. We're not usually, again, that's a little bit more venture-y for us, but for a smaller software company, it's like achieving profitability, you're going to ultimately, like, you're doing this to make money, right? So the only reason why you wouldn't be achieving profitability is because maybe you're taking on all this, more venture capital and deploying it to try to grow excessively and sell. But if you're someone, like you said, who's like not thinking about selling, well, the first thing you should be trying to do is, how can I do what I'm doing today in a profitable way, and then continue to grow in a profitable way. I think if there's never any problem with, growing profitably.
Create a great business, basically. Just
Yeah,
create a great business.
and solve a specific problem though at the same time. Like, being another MarTech company that anybody could be our client. It's like, well, that's not actually what you should be creating, because all of those probably already exist, right? But if you're a marketing software for specifically law firms, it's like, well, you can build a nice brand there, probably grow and be attractive to outside capital, because again, you're solving a specific problem.
Yeah. It's very hard to build a horizontal platform, much easier to tackle something in a vertical for a niche, for a smaller market. And then you can expand from there. Let's wrap up with a quick rapid fire. Some rapid fire questions. Sound good? So you've built, sold, and now broker deals. Which side of the table is more fun, operator or originator?
I like what I'm doing now. I like originating.
Nice. What cold outbound strategy is working best right now? You got email, LinkedIn, picking up the phone, text messages.
I think sending a personalized, well, I would say this: setting a personalized email and then following it up with maybe like more of a video or an audio recording seems to work well, because you're showing somebody like, hey, a person sent this.
No, really, I want to talk to you.
Yeah. It's like that first email or that first LinkedIn message is still noise, because those are such noisy platforms. But then taking a second to maybe do that second message with a more personalized, like, this is my voice and I'm speaking to you, Brian, I found that works pretty well.
Yeah, I watch them. Like when a founder reaches out to me, they'll send me a deck and I'm just like, fill out the form, whatever. Cold inbound. Yeah. And then they'll send me a video. I'm like, all right, I got to watch the video. Okay, it's 25 seconds. I'll watch it.
The looms work pretty well. Loom's a cool tool.
Don't make it too long, like 20 seconds. Like, hey, blah, blah, blah. Makes them a real person. Besides you guys, who's doing deal sourcing in the private equity world right now? Right now.
There are actually a number of investment banks that do a pretty good job. I can't say anybody specifically. There are a number of, like, middle market investment banks that I think, when a lot of them focus, and, if you go to their website, they focus mostly on the sell side. But if they get hired to do buy side work, if you've built an investment bank that's been around for 10, 20 years, you're doing something right. You know how to get deals done. So I would say them. I would say who's not doing it, which might be a better question, is people who are, maybe a marketing agency that's offering to set you up with phone calls. Phone calls are not deals. Phone calls are a waste of time. Unless you know the statistics of a company and that they're interested in selling and that they are a fit for your thesis, then you don't want to talk on the phone. So we try to find that information and bring it to our clients and not waste their time. And we have no problem wasting our own time finding that information. But that's an important part of the service. There's a lot of people out, pitching appointment setting as deal sourcing. They're not the same thing.
Doesn't work. Yeah, I agree. What's an underrated metric every founder should be tracking for exit readiness?
Underrated is customer concentration. I would say if too much of your business comes from one customer, you're going to get penalized for that on evaluation. So although it's always great to take, on big customers if you can support them, just know that a buyer is going to penalize you, because if that customer decides to leave, your business might get shrunken in half overnight. So you can still sell it. Just know that it's more attractive to a buyer if you have 100 customers than 20 but one pays a majority of the revenue.
Who's a founder or CEO or somebody from an industry you want to interview on your podcast?
On my podcast, I mean, I'm a pretty big fan of Alex Hermosi. I think what he's doing is pretty cool. He's actually playing in the private equity space, buying and acquiring businesses. I think his advice is usually pretty spot on, and he condenses it down into like very succinct advice. So I think he's a pretty cool guy who's making a big name for himself in that space. I'd like to have Alex on.
Nice. Alex, if you're listening, there you go. What's a book or resource every new PE associate or anyone getting into this ecosystem should read?
PE related book. I mean, again, shout out Alex Hermosi. I liked his book, $100 Million Offers. I thought that was a pretty cool book. I liked a book called Tools of Titans by Tim Ferriss. I thought that was a cool book because you get to see, he interviews in that book like a couple hundred very, very high performing people across a number of different industries and focuses, and whether they're athletes or business owners. And it kind of shows you the comparison of like the traits across, whether they're an extreme sport athlete or a CEO, a lot of them believe in and follow the same kind of traits to be like super high titans in their space. So that was a cool book.
Very cool. Well, thanks so much for coming on, Joe. We went way over time, and I really appreciate you taking all the extra time. I learned a lot.
Yeah, man. Thanks for having me. This has been great. I always like to come on here and talk about, things. And honestly, you've had some really good questions. So kind of test me a little bit on some certain topics and, things I've learned. But thank you. Thank you, Brian. I appreciate it.
Thanks, Joe.